What is going on, everybody, and welcome back to the channel. My name is Kramer, and in this video, I want to answer the question, how does a hard money loan work? So without further ado, let's go ahead and jump in. So what is a hard money loan? It is a short-term real estate loan funded by a professional lending company. It's asset-based, meaning approval is mostly based on the property's value, the potential value once you fix it up, also known as the after repair value, and it's not based on your personal income or credit. Now, your credit score matters a little bit. Obviously, these companies want to lend to people who have solid credit scores, but you can oftentimes get a hard money loan no matter your credit score to a certain degree. These types of loans are commonly used for fix and flips, BRRRR deals, or bridge financing. But the main two that we're going to talk about are fix and flips and BRRRR deals, since those are the most common. And I mentioned before that these are short-term loans. And when I say short-term, I mean they're typically between 6 months and 12 months. Or in other words, you have between 6 months and 12 months to pay these loans back. These loans are solid because they have competitive interest rates. The biggest downside is they do have higher fees and higher points to them, but we can close on these really fast, which oftentimes is very beneficial to real estate investors. I personally closed a hard money loan in about 9 days, which is pretty fast. So how does it differ from a private money loan? Well, I'll tell you up front, they are very, very similar. A private money loan is money you borrow from an individual, whether that's a family, a friend, a coworker, but not a big company. So a hard money loan is essentially a loan from a big company. A private money loan is a loan from either a smaller company or really a person, like a friend or family. The good thing about the private money loans is the terms are flexible and negotiable. Whatever you and your friend or you and your family member can work out, that's the deal you're going to get. These loans are oftentimes based on relationships and trust, and not just like strict underwriting from the companies. And since you're able to negotiate the terms with a friend or a buddy, you can negotiate lower fees, lower interest, but of course you need to build connections and have credibility. So in short, hard money and private money are essentially the same thing. It's just a loan for a real estate transaction. The biggest difference is a hard money loan comes from a company, while a private loan comes from a person. And in this video, when I say hard money loan, you can also accomplish the same thing with a private money loan, but I'm just going to be using hard money because that's the example we're going to be giving. So let's go through an example. Let's say you find a real estate deal. The purchase price is $100,000, the renovation cost is $30,000, and the after repair value is $200,000. Well, you know that's a great deal, because if you're going to buy a property for $100, put in $30, so you're going to be all in for $130, and it's really going to be worth $200,000 afterwards, that's a great deal. The problem is you might not have $100,000 for the purchase price in your bank account right now, and you might not have the $30,000 for the renovation in your bank account right now. And just to be clear, this is just an example scenario. You could add a zero, you could say it's 500,000, whatever the case may be, these are just example numbers. But if you don't have the money to do a deal like this, but you still have a great deal on your hands, this is where you'd use a hard money lender. So you'd call someone like me and you'd say, hey Bailey, I have this deal and I need a hard money loan. And seriously, if you do have a deal that you need financing on, you can email me, bailey@investorfirstcapital.com, and I can help you out. And I'll ask for a few things up front. I'll need to know your estimated credit score, how much experience you have in real estate, how much cash you have in the bank, and the deal numbers, like we already talked about, the purchase price, the renovation cost, and the after repair value. Once I have that information from you, I'll then run you a quote that will look something like this. So here is a sample quote on a hard money loan for a deal like this. So just to go through some of these terms, because some of them are kind of funky. Number one, we have the loan amount. So in this scenario, you needed $100,000 for the purchase price and $30,000 for the renovation. So that's $130,000 total. Well, in this scenario, the loan amount, depending on your experience, is only going to be for $120,000, meaning you're going to need to bring $10,000 to the table for the purchase price of the loan. Now, if you're an experienced investor, like for myself, I've gotten hard money loans for 100% of the purchase price and 100% of the renovation. So this just depends on experience, and again, is just an example. So the hard money lender is going to give me $90,000 towards the purchase price. I'll bring the other 10 in this scenario, and they're going to give me $30,000 for the renovation. Now my monthly payment, because I need to pay monthly interest, is going to be $712, and my interest rate is 9.5%. So how much cash am I going to have to bring to closing? Well, the answer here, it shows us, is $17,000. Now, how did it come up with that? Number one, the down payment. So we need to bring $10,000 for the down payment. The origination fee is $5,900. So again, with hard money loans, the fees are higher. And then there's a service fee, $999. And then you're going to have to pay essentially 1 month of interest up front. And then there's going to be closing fees with the title company, but that's not through the hard money lender. So then going down, additional terms. The term is 1 year, so you have up to essentially a year to pay it back. It is an interest-only loan. This lender is going to be in first position, and this just walks through the deal. So the purchase price is $100,000. The after repair value is $200,000. The loan that you're getting to the cost is 90%. So the lender's giving you 90% of the cost. And then I want to touch on this number again, the holdback amount. So the lender is going to fund the $30,000 of renovations, but they do require you to pay the renovation costs out of pocket up front, and then they'll reimburse you. So what I do for my deals, when I use a hard money loan, is I'll usually put between $10,000 and $15,000 in renovations on a credit card. Once I do that, I'll submit a request to the hard money lender, and then they'll wire me the money to reimburse me. And we'll talk more about what that looks like here. So let's just say I show you that loan sheet and you're like, okay, that sounds good. So the next step here is some lenders we work with will require an in-person appraisal. Some will not. So some can just do it, on their computer. They can run the comps. It just depends on the deal, the area, your experience. But when it's time to close, you will then wire the amount required to the title company. So in this scenario, it was roughly $17,000 that you would wire for closing. Once you close on the property, you're going to renovate it. Now, we already talked about how the renovation funds are held back by the lender. So you're going to actually complete the work. You're going to fund it up front using your own cash or a credit card. And then you're going to submit a draw request, which on a really simple Google sheet or Excel sheet. Sometimes the lenders will send out an inspector. And this is not like a city inspector. This is just usually like a handyman that they connect with in the area to take pictures and verify the work is done. And then once approved, the lender will reimburse you via an ACH or wire. And then you're going to also have those interest payments due once per month. So in this example, it was like $712 per month in interest. Again, as I mentioned before, every 2 weeks or after $10,000 to $15,000 of spend that I do, I like to then submit my reimbursement to the company. Now, once renovations are complete, you have two options to pay off the hard money loan. Option number one is you can sell the property. So this is like the fix and flip, where you just sell the property, you take your profits, and you move on. Or the other option, which I like the best, is to refinance. This is where you'll pay off the hard money loan with a new long-term loan, typically a DSCR loan, commonly part of the BRRRR strategy. And again, you can contact me, Bailey at investorfirstcapital.com, and I can help you with the refinancing portion of this. So in this complete example scenario, this is what it would look like if you refinanced. So remember, our all-in costs were $130,000. Our outstanding loan amount was $120,000 because we had to bring $10,000 to the table towards the purchase price. And if this property appraised for $200,000 and we got a 70% loan to value refinance loan, that'd be $140,000. Now I know these are a lot of numbers, so I honestly encourage you guys, reach out to me here and I can help you walk you through specific scenarios for your deal because I know this is a lot of numbers. But essentially, you're going to get a new loan for $140,000 that will then pay off your existing hard money loan at $120,000. Now, you're like, okay, Bailey, but there's an extra $20,000 there. What do I do with that? Well, a lot of times, the extra money will either, number one, cover closing costs. So in a deal like this, the closing costs aren't going to be $20,000. But with a DSCR loan, you do have to prepay some insurance, you do have to prepay some taxes, and there are some other closing costs that you will have to pay. So there will be money left over And it is possible to pocket some of the money. But let's just say in some scenarios, when you refinance, the after repair value isn't going to be $200,000. It's going to be less. So there is going to be some scenarios where you might have to actually bring some capital to close in. Totally possible, and of course, all deal dependent. And you can use a DSCR loan or a conventional loan to refinance. And then you repeat and buy more properties. So hope that answers the question of how does a hard money loan work. If you guys have questions, go to investorfirstcapital.com. You can email me at bailey@investorfirstcapital.com. I'm here to help you guys through your deals. Thanks for tuning in, and I'll see you guys in the next one. Peace.